Hello, hello, y'all. It's Brandy with Better Business Strategies here for another episode of Business Bites with Brandy. And today I want to share with you 3 easy ways to boost profits. Now, normally we just chat or I have a guest, but I'm going to be using slides today. So if you are catching the podcast and listening, I'm going to do my best to explain the visuals that I'll be using, but I highly recommend that, especially for this particular episode of Business Bites with Brandy, that you come and check out the YouTube channel, Better Business Strategies, and look. I believe this is going to be episode 8. It'll be called 3 Easy Ways to Boost Profits. So find that on YouTube, and you'll be able to visualize the visuals as we go through them. And if you're just tuning in, give me just a minute and I'll do a brief introduction so that you can get to know me a little bit. But first, for those of you following along, I am going to share my screen with you. Here we go. Technology, it's amazing. All right, 3 easy ways to boost profits by Better Business Strategies. All right. My name is Brandy Renee. I have an MBA in accounting and finance, and I'm a certified professional coach. I call myself a holistic business strategist because I take life coaching strategies and use them to help my clients get happy and healthy in their life so they can show up to generate profit in their business. Now, the company name is Better Business Strategies, and you can find me at www.betterbusinessstrategies.org. My phone number's up there. I am based in Hawaii, though I often visit San Diego where my children live. And I'm originally from Colorado, so every once in a while I'll do a show from the Rocky Mountains, Mile High City. All right, I serve clients internationally on the mainland and locally here in Hawaii. I've been coaching for 4 years, consulting for 10 years, and working in accounting, finance, and human resources for over 20 years. I look pretty good for being in the industry that long, right? All right. Now, if you followed the show for very long, you know I often focus on profits and not revenue so much. And that's unusual because usually you'll hear consultants, coaches, and business people talk about revenue or income. Increase your revenue, generate more revenue. What was your revenue the last year? Learn how to generate 7 figures in income. You've read them, you've read those headlines, you know what I'm talking about. But the number that really matters most is profit. How much money is left over after your business has paid all of the things it takes to earn that money? So the next time you hear people talking about revenue and telling you how much revenue they made, I want you to stop and remember that they're leaving key components out of that flashy number they're sharing with you. And if you get a chance, ask them how much their profits were or how much their expenses were over the year. Because if they're generating $10,000 a month in revenue, but it's costing them $7,000 a month to generate it, then they're only putting $3,000 a month in their pocket. And it's pretty hard to run a business and keep staff sustainably for that amount of money. So remember, profit's king. All right, let's look at the difference between profit and revenue so that you can understand why profit is a better key indicator for how healthy your business is. Now, revenue could be from the sales of products or services or memberships. It can also be interest income, royalties, rental income. Basically, it's the money that you collect from customers and clients before deducting any of the expenses that that you have to pay to run your business, and that includes the fees for collecting payments. And I just want to do a little PSA here for all my accountants. Probably give me a round of applause for this. If you are recognizing revenue as the amount that you get from PayPal or that you get from Stripe, you are not recording an important cost. The amount that it costs you to get that income from those payment platforms. So just a little heads up that you need to recognize the entire revenue amount and track those expenses so that you know how much it's costing you to work with those payment platforms. Okay, PSA done. Now, net profits are what's left after the indirect. Oh, wait a minute. Let me back up just a little bit. Gross profits are what's left after the direct costs are deducted from the revenue. And direct costs are things that are directly related to making your product or service. It might be the raw products or the raw materials that you need to create parts, or that you need to create lotions or cosmetics, or to put pieces together to make a whole widget to sell. Direct costs can also be the labor hours that you pay people to put that widget together, or the labor or the hours that a consultant or an engineer spends on a client or a project. Those are direct costs that go into making that widget or producing that service for that hours. And these are commonly called cost of goods sold, or COGS. Okay. Now, net profits are what's left after the indirect or overhead expenses are deducted from the gross profit. It's the money that's left over after you've paid everything it takes to deliver that product or service. Now, a company can have high revenue and low profit if it has a lot of expenses, or it can have low revenue with high profits if its expenses are low. Depending on how well a company manages its cost of goods sold and manages its overhead expenses. Years ago, I worked for a machine shop that made metal parts and rolled steel, rolled copper. That kind of stuff is really expensive. Shipping it is really expensive. And when I first came into the machine shop, there was a lot of waste. Um, the machinists that we had out on the floor, a lot of them weren't that skilled, and so they were making mistakes. We had a lot of scrap metal. We were having to rush materials in, having to overnight metal tubes so that we could finish projects on time. And our cost of goods sold and our gross profit margin was terrible because of all that waste. Now, once we got some quality machinists in there, we put in some Q&A, we had some accountability, and we got a good handle on not overnighting material anymore. Our gross profits really shot up because we were managing our COGS, or our cost of goods sold. And you can, even if you have low cost of goods sold, expenses, overhead, having a warehouse that you pay a high lease for, that can really eat up your net profits. So, keep an eye on those expenses. Keep an eye on those expenses. They're gonna have a huge impact on your bottom line. All right, on to the next slide, y'all. So the first two strategies that we're going to talk about today are going to have a direct impact on the bottom line. So when you cut your costs, or you increase your prices, that amount becomes profit. Now, I have an illustration up on the screen. If you're with me here on YouTube, you can see it. But for those of you listening to the podcast, along the left side, we have revenue, cost of goods sold, gross profit, expenses, and net profit. And the first column shows our original amount. We make $100 for every widget that we sell. It costs us $50 in direct cost or COGS, and that leaves us a gross profit of $50. Now, our overhead expenses are $10 per COG, and that leaves a net profit of $40. At the end of the day, after everything is said and done, we're going to make $40 for every widget that we sell out in the marketplace. Now, what happens if we reduced our cost? And in the second column, you're going to see our revenue remains the same. We haven't done anything with the price. We're still going to make $100 for every widget that we sell. Now, we have reevaluated our vendor contracts. So we've worked out some new deals and we lowered our cost of goods sold. And we're only going to pay $47 for every widget that we make now. That's a reduction of $3. And we're going to see that in the gross profit. Our new gross profit is $53 versus $50 from before the change. Now, we're also going to lower our overhead expenses. Maybe we move to a new facility and we have a less expensive lease. And so that's going to lower our overhead per COG by $1. And that's going to give us a new profit margin of $44. That's $4 more than our original net profit amount of $40. Now, the second strategy we talked about is increasing prices. So let's look at that in the next column. Now, if we raise our price by $5, we're selling that widget for $105 instead of $5. We're going to leave our COGS, we're going to leave our expenses alone because I want you to see that the impact that raising the price has, right? So COGS are still $50. That's going to give us a gross profit margin of $55. Those overhead expenses stay the same at $10 an hour, and we have a net profit of $45. Now, this is the great thing about the small shift, big impact strategies that I use with clients, and that both of these strategies, lowering your cost and increasing your prices, can usually be done within a couple of weeks, and you'll see the impact on your bottom line on the next month or certainly within the next quarter. So if we compound these changes, as you can see in the column all the way over on the right, we're going to compound these changes and you're going to see an increase of $105. That's our extra $5 for the widget, and our new cost of goods sold at $47 is going to give us a gross profit margin of $58. We have those new overhead expenses at $9, and that's going to give us a new total net profit of $49, or an additional $9 for every widget that we sell. Now, $9 may not sound like a whole lot of money, but if we're making 1,000 widgets a month, we're going to see the change in a much bigger level there, right? So our original profit margin was $40,000 a month, but we lowered that cost, which gave us an additional $4,000. We increased our prices, which gave us an additional $5,000, for a compounding effect, giving us $49,000 profit margin for that month. It's a $9,000 profit increase. Now we multiply that times 12, and that's $108,000 a year in additional profit. So as you can see, these two strategies have a direct impact on the bottom line, and usually without increasing cost. And we'll see what that looks like with some other strategies in the next slide. All right, so I promised you 3 strategies, and your third strategy could be any one of these: increase lead generation, new service or product lines, digital marketing, improve messaging or exposure, alliance or joint ventures. I could tell you a dozen more strategies that can improve your profit margins, but almost all of them are going to have less of an impact on your bottom line because they're going to generate an expense counter to every revenue dollar that you make. So how does that look? So you might increase your lead generation by hiring someone, an appointment setter or a marketing firm to generate more leads for you, and that will increase your revenue as you get more clients or you sell more products. But you're also going to have a counter cost of paying that marketing company or paying that lead generation service. And so the profit you make is going to have a slightly less impact on the bottom line because there's going to be that counter cost. The same with a new service or product line. New service or product line might be a great new revenue stream for your business, but chances are that you're going to see a cost impact. And you may even have an upfront cost before you see an ROI or return on your investment. You might need to utilize a credit line or borrow money to invest in equipment or professionals to implement some of these strategies, meaning that you're going to have to leverage your company a little bit before you even see that revenue increase. And those additional costs or expenses are going to actually lower your profitability before you kick off that new product or service line and see an increase in your revenue. So once again, not the same impact as we saw on that previous screen that lowering your costs or increasing your prices have. So, let's talk about another one. Alliances and joint ventures can be a really great way to expand your reach by working with someone and reaching their market, but there's a pretty good chance that you're going to have to share in the profits. So, yay, new customers, increased revenue, but now I've got to, split my profits with this guy that I'm working with. It's 60/40 or 40/60, or even if it's 50/50, right? You're going to still have a cost offset for these other strategies. All right, so I want to talk about one more set of terms that you probably hear a lot, but you might not know how they relay information about your business. Profit margins are the measure of profitability expressed as a percentage of sales. The higher the number, the more money a business is going to make relative to its cost. And for those of you that are listening in on the podcast, I have a grid with the prices up again. And this time we have gross profit margins figured in. So if we are making $100 per widget and that cost of goods sold costs $50, we have a gross profit margin of $50. Our gross profit margin is 50%. $10 for overhead expenses gives us a net profit of $40 or a net profit margin of 40%. These are all very simplistic numbers, as you can see and hear, and every business is different. So at any point, if you want to figure out, if you want help figuring out your profit margins, or if you want to see how any of these strategies can impact your business, I recommend that you give me a call, set up a time, bring your profit and loss, and we'll look at it, and I'm happy to help you figure out your profit margins. So let's talk a little bit more about gross and net profit margins. So the gross profit margin shows how efficient the company is at creating its product or how much value a direct service hour has to the customer. Gross profit margins only consider direct costs or COGS, not overhead, not taxes, not interest payments on debt. It reflects how well a company generates profit from its core business operations, right? Making that product or service, or directly serving the client with its labor. Now, a net profit is the indication of how well a company manages its overhead expenses, but too high of a net profit can also indicate that an organization isn't reinvesting profits to grow the business as it should. Net profit margin represents the overall profitability of a company, considering all of the expenses, including non-operational items. Now, margins are different for every industry. Food and beverage has low margins, especially as inflation has increased has increased prices. It's a little harder for food and beverage to squeeze out profit. They also have a lot of loss because food is perishable, and so if they are not really efficient about using fresh foods like they should, then they can have their profit margins eaten up by the food that they have to throw out. Now, other companies like Prada, for instance, have a high profit margin, right? Because the customers pay for the brand name, and the same it costs the same leather to make other purses, but you buy Prada so that you can own Prada, and you pay for the brand. And there's not a lot of labor or product costs that go into brand, and so they tend to have a higher profit margin. If you want to know how your profit margins look, check out the benchmarks for your industry. You may find you're more efficient than your competitors, or maybe your overhead is above average because you pay for office space in Honolulu, which is one of the more expensive commercial real estate markets in the US. It really depends on what's going on in your business. But understanding your industry benchmarks and understanding how you line up with those and why you line up with those can be really important, especially if you're in a growth period or you're trying to expand. Look at what your industry benchmarks are so that you get a good idea of where you're efficient, or maybe where you're not efficient. You need to tighten up some controls, cut some fat, streamline some situations. But definitely a good idea. And like I said, every business is different, every industry is different. So if you are curious about what your, I think that's the last slide. Yep, that's the last slide. All right. If you are curious about where your profit margins should be, then definitely give me a call. I can help you either do some research for you, and we can look at your P&L and see how you line up, or I can point you in the right direction to do some industry research yourself if you'd like to do that. All right, I don't know if you can hear Shelby Dog here. It's dinner time. So I hope that information was helpful and not just a fire hose of numbers. You might need to watch this one once or twice, maybe slow down the recording a little bit. But if you have any questions here, I'm always happy to explain further, to look over your numbers with you, and to help you understand what's going on in your business. Because when you have understanding, you can make better choices, and better choices help you grow. Okay, have a wonderful day, and keep your eye out for the next Business Bites with Brandy. I will have a special guest next time. All right, mahalo for watching, and thank you so much.